Hey, I'm excited. I am excited for tonight. Let me just do a quick screen share, make sure you guys can see that. Give me the thumbs up if that looks good. All right. Hopefully that shows. Fabulous. Well, I am super happy to be here, although it's remote. It is a special opportunity because we get to unify two different kindred spirits in two different communities, both the Brandeis and the Babson ones. And so all of you are working on some early stage startups. After a little bit of prep work, it sounds like a number of you are working at similar stages. And so I hope that you'll get to connect with each other throughout this. I would like to keep this as interactive as possible, as we can do on Zoom. So if you have a question or a comment or an experience at all, definitely put it in the chat. I'm also much better interacting with folks. And so as we're going through something, even in the middle of it, although I can't see everyone on my screen because I'm limited to about a dozen faces right now, chime in, take yourself off of mute, jump in. I think it'll actually be much more interactive, much more fulfilling for everyone that way, especially if you have a question, it's likely someone else is thinking about the same question. The materials I actually put together and I posted this online. And so don't feel like you need to take notes. The URL down below, I've put this presentation, a handful of others. And what I'd like to do is probably bounce around a little bit depending on where the conversation goes. And there's a ton of stuff. And so I don't plan on running through it all, but we'll see how we go as we go along. And so what I want to do is just spend just a couple of minutes giving you a little bit of sense of my background, because my perspective will influence what my views in terms of fundraising. And so my quick bio is, I was originally a software guy. I worked at a big company. The first chapter of my professional life was essentially in the go-go 90s of New York. And if you've ever been to the trading floor of an investment bank, you know how noisy that floor is. And that's a picture of one right there. This is about as far away from startups and entrepreneurship as you could possibly be. I was a tech guy. I actually deleted a production table in the middle of a day. And so if you're technical, you have a sense of what that means. I stopped the entire trading floor for about 30 minutes. And that's about the riskiest thing I did. But this is so far away from being an entrepreneur. I came to New England in the late 90s for grad school, thinking that it would be a great place to spend 2 years. 2 years became more than 20. In the second chapter of my professional life, I was an accidental entrepreneur. And the reason why I call myself that was like, when I went to school, I didn't think I was going to do a startup, but I ended up hooking up with a handful of people that did. And so if you fast forward 15 years, through a little bit of luck, a little bit of perseverance, I ended up at 6 different startups, 6 different acquisitions. But throughout that all, just met thousands of amazing people that I got to work with. And so got to see the ups and downs of an operator. And through this, the kind of third chapter of my life has primarily been as an angel investor. So this is probably the last 5 or 10 years. I've written about 70 checks. A lot of them are really small, and so it's not a crazy amount of capital. But through this process, I got to see thousands of startups and thousands of entrepreneurs. And I got to see like what people did well and what people didn't do so well. And so hopefully I can share some of those mistakes and some of those lessons learned. And then one final note before we dig into the content was that I am super fired up and drawn to the promise of student entrepreneurs, whether you're a current student or you're a recent grad. Lucky to work with a handful of schools in the local area. If you look really closely at this photo, you actually see Juan Giraldo in the background. And so if you maybe bonus points if you can find him, but he is in the air. But so today should be fun. I'm glad that we're bringing together these two different communities. So let's dig in. There are 3 different topics that I want to touch upon. So the first one, some fundraising basics. As I mentioned, I'm going to skip around a little bit. And so we may not spend all that much time on basics, depending on what the folks on this call know. The majority of it is going to be a tactical 5-step process in terms of how to raise a round. And then if we have some time, I'm happy to share some lessons learned and tips. The tips fall into founders tips, execution tips, some pitch tips. It's sort of a hodgepodge of lessons learned across the years. And so on the basics, I do want to pause for a second and get a sense from you. what are the obstacles that you're facing right now? And so when you think about growing your venture, it could be financing, could be something else, but I want to hear from like 2 or 3 of you. And I'll start it off with some of the examples that I've heard recently. One question from someone was they were doing some work in clean tech and they wanted to know, how do I connect with clean tech investors? So that's pretty common. Like, how do I connect with investors in my industry? Another question that I recently got was, how do I get funding in an industry that is no longer a hot industry, right? And so in this particular example, it was ad tech and martech. And then I often get the question of, how do I find my very first investor, right? And so those are a couple of examples. So I'd love to hear from 2 or 3 of you. What are some of the obstacles that you're facing right now? And when you share that, give me like the one sentence of what you're working on. Yeah, jump in.
So how do you get funding when your startup has little traction?
Got it. Okay. Yep. In the early stages, it's a great question. Hear that a lot. Yep. A couple more. Don't be shy. If you're thinking about the question, someone else is.
Is it okay to go back to an investor that turned you down at a later time?
Okay. That's a great one too. Yeah, when is no an actual hard no? Yep. Maybe one more. What's an obstacle that you're currently facing?
So when looking for investment, is it better to look for venture capitalists inside your country or like go to the US that has so much more money?
Got it. Got it. Okay. That's a great one as well, like geography. And what country are you in?
Mexico.
Got it. Okay, good. We've got a couple Mexican entrepreneurs ourselves. Okay, good. As we go through this, please jump in as you have other questions. One of the first things to look at in terms of your business is like, what trajectory is it on? And there are generally 3 different paths. So one is the mission oriented. It might be a lifestyle business. It's a social enterprise where the exit itself isn't specifically the goal. And so that has a different trajectory, and it depends on how you finance that venture. There's a whole other category where it's more about like linear growth, where some services business fall into this category. You could be revenue finance, like you may actually be bootstrapping. And so there's a certain trajectory around those linear growth businesses. And then there are a number of these businesses where you actually have to go into a pretty big hole up front that requires some sort of capital before you come out the other side. And that's typically when we think about scalable business models. And so put yourself in like one of these 3 categories, and it depends on where you get that first dollar, depending on which category you fit into. The very first dollar, it doesn't always have to come from equity. And so the title of the session was Fundraising 101, how to land your seed round. Now, that really orients around the equity side, but it's really important to note that there are lots of different places where you can get that first dollar. And again, this is not an exhaustive list, but I'll just touch upon each of them very briefly. Revenue is fantastic. I'm sure you guys have heard that before. If you have a product, obviously, if someone will buy it, that's top of the list, right? Like you're actually generating top line revenue. Sometimes it can be prepaid, like a la crowdfunding, and other times you may be developing a product, but in the early days, it's more about a services business where you're charging for your time and building something that then gets subsidized into the product. And so that's category 1. There's another one around partners where you can pay for services later. They could be in kind. You can get pretty creative on that front. And so if you have a major partner or another entity where you can do some business with, keep in mind that you can do something along those lines where it may not be recognized as revenue, but you be able to, in essence, finance part of your venture that way. Grants are non-dilutive. So whether you apply for a grant, get something from the SBIR, pitch competitions, there's a handful of organizations that will get you some amount of funding that's non-dilutive. And so that's also a great option. And then there's this category of borrowing, right? Whether it's a bank loan, personal loan, the SBA can borrow. Debt has a different cost structure than equity. And this last piece around equity is the most expensive, whether it's done as a SAFE, as a stock, through convertible notes. And we'll dig into a little bit more of what that means. When you think about where capital comes from, put it on this axis where on one side, it's the size of the investment. And so if you look at this chart, On the left side, the smallest checks are there, right? And so whether it's an angel investor or with the advent of crowdfunding, these are checks that could be like $100, right? So on the smallest side. And then on the other side, millions of dollars, right? So 10, 20, 30 million. The y-axis is how costly is it from your standpoint. So if you're an entrepreneur and you have to go and spend a ton of time and energy convincing someone to invest, then that's costly, right? And so you'll see as this is laid out, the ideal sources are the ones that are relatively little time and cost, but bigger checks, right? You don't get a lot of those, but keep in mind as you talk to different players, there is this trade-off. One question that we recently got was around what's it like to raise during a pandemic? And even though things are recovering well in the US, there was still this like fear that things were just going to go on ice for a little while. And the net of it is you click through, there's a couple different lists that are out there. It lists the VCs that were active during this period, who was taking meetings. The rough rule of thumb was that we generally saw a hit in valuations between 20 to 30% on average, but so many businesses actually took off during the pandemic that valuation hit wasn't actually completely accurate, right? So some did better because of the environment that we're in, but as a rough rule of thumb, we saw a little bit of a dent on that front. Did want to spend a moment just on crowdfunding. And so I think most of you are pretty aware of rewards-based crowdfunding. That's the Kickstarters and Indiegogos. If you click through to the link, I left it in the notes, that there are a handful of these crowdfunding sites that are better for different purposes. So Kickstarter was great for kind of overall product. Nonprofits really, Causes was a great site for that. If you've been on Patreon, so that's great for creators, or for personal fundraising, there's a GoFundMe. And so there's like a handful of those that are on the left side, which may or may not be applicable to you. If you have a consumer product or a product business, those tend to be viable options, right? On the right side are equity-based crowdfunding platforms, which has really taken off. I'm not going to go into the specifics or the semantics of this, but the regulation that governed how much you could raise via crowdfunding was recently lifted. And so it used to be like $1.07 million was as much as you could raise. And so they bumped that to 5. And so it's a viable option. And the way equity crowdfunding works is, in essence, you are selling some of your company via stock, but to a crowd of people. And those checks can be as little as 100 or as high as 1,000 or 2,500. So it was another thing that had happened in the fundraising ecosystem that you should be aware of that could be an option for you. Okay. Now, on the venture capital side, because it sounded like a handful of your businesses are venture capital or venture scale, the main takeaway from this one is that there are distinct stages that venture capital falls into. And when you start from zero, the first check, if you're going to raise funding, whether it's through friends or family, and friends and family is kind of a misnomer. It's essentially anyone who knows you from your earlier life. So it could be a colleague in the past. It could be someone that you babysat for. It's essentially someone who is basically trusting you more than anything else. And the reason why I wanted to pull this out was that the dynamic of selling that person is really different. So often they actually don't know much about the business. And because they're investing in you as the founder, they're just like, well, I trust you. You have been a pretty stand-up person. You generally, when you say you're going to do something, you do it. And so their bet is in you as a person. And the earliest days of a venture where you have no traction, sometimes very frequently actually, the first couple of dollars are coming from your immediate network. And so let's say you don't have much of an immediate network or circumstances where you can't really tap into it. The next ring or the next stage are angels. And in this case, whether it's an angel group or a syndicate, there's variations of that. The opportunity that you have in front of you is you have to convince someone that doesn't know you, both of you as well as the idea. So there's two things that they're buying at that stage. May not have any traction, that's perfectly fine. You may find an angel that has been wanting to make a bet in the space, in which case they believe in the space, and now you just have to sell them on yourself. Or they get to know you, maybe they don't know the space particularly well, and through a couple conversations, you essentially establish some sort of credibility. And then beyond that is institutional. So these are like the seed funds and the pre-seed funds. And then when you go to growth equity, they're much larger. And so when you raise funding, they fall into these distinct stages. And so that's definitely something to keep in mind. One mistake that I made in the early days was not understanding how the VC game actually works. And when you look at it from the perspective of an investor, their economics are completely skewed, right? If they make 10 investments, they will basically return the fund through one home run. So every time they look at a founder, they're trying to figure out, are you the one that's going to yield 10x the amount of capital, right? And the mistake I made was that when I was pitching to VCs in the early days, I was probably pitching something that was more of like a modest return. And so it wasn't being aggressive enough in terms of how to portray the startup. And one thing I hear a lot from people is that they don't feel comfortable in the early days, basically painting this really big picture. But the thing that you've got to keep in mind is that if everything goes according to plan and all the chips fall your way, that's essentially the picture that you want to paint, right? And so keep that in mind, because what happens is for all the other entrepreneurs that a venture fund invest in, they will fail. And so they're really looking for the home run. So keep that in mind, because they are swinging for the fences. One last point before we go into like the tactical how-to is that whenever you raise a round, there's three things that have to be kept in sync. So the first one is what your ask is, so how much you're raising. The second one is what are you going to use the money for? And the third one is the milestone. Like, what are you actually going to produce at the end of that? I'm going to walk through each of those in a little bit of detail. So this one is generally pretty easy for people. Like, how much do you need, right? You have a rough sense of what that number is. The challenge I hear from a lot of folks is they don't know whether or not they've found like the right amount of funding. And one way to stress test this is that if you were to raise half the amount of money, what would you do? And if you were to raise twice the amount of money you're asking for, what would you do? And if the answer is like not much different, you would just last for longer, you haven't really hit upon that ideal spot. And so what you're looking for in this case is you're looking for the amount of capital that will go into the company, that will prove something out on the other end, that will then change the valuation of the company. I know it's a sort of abstract concept, but as we go through the others, hopefully you get a better sense of that. And so the first one is around what you're raising. The second one is really easy. Like, most people generally understand what they're going to use it for. Are you building product? You're paying marketing people? Are you doing customer acquisition campaigns? Do you need the capital itself to finance inventory? Like, that just basically comes out of a spreadsheet. So I'm not too worried about that. This third one is the one I do want to park on for a moment, which is like the milestone. Frequently when entrepreneurs talk about raising a round, let's use an example. You're raising $250K for your pre-seed round. It'll last you 18 months and you're going to build product with it and you're going to hire 2 people, right? And so that's kind of easy to explain. That's your last slide in the deck when it comes to the ask. The thing that you really need to communicate to investors, like, what actually happens to the venture at that point. So at the end of it, you don't just simply run out of money, right? Like, that's not a great investment, that you basically have to raise another round. And so the way to think about this is it's some milestone, something that's qualitatively different about your startup at that time that changes how much the startup is actually worth. And so as an example, day one, you've proven nothing, you've got no traction, right? After a little while, you're building a team, you're finding a co-founder, you maybe have developed a pilot product or a test product. And so maybe this prototype is out there. You may not have a paying customer, but you're starting to de-risk the venture. And so there's some combination of these variables, which leads to you showing that the venture itself has a different risk profile. And so let's say the next round, you raise a little more money, you start to see some market demand, people are starting to pay, you're starting to see more execution, in which case then you can express that the startup itself is more valuable. And so that's essentially what investors are looking for. And so if you go back and you think about what your round is, fast forward things some period in the future, so like 18 months, and then how would you describe your company at that stage? Right? So it's hopefully different than where it is today. And so that delta is something that you want to drive home when it comes to your ask, right? You're painting this future vision, and that's essentially what you want to tell an investor. Okay. So I'll pause there for just a second. I kind of just threw out a bunch of stuff, but these are just some of like the basics around fundraising. So hopefully you've had some experience with that. And again, as you have questions, please chime in, please interrupt. And maybe even more importantly, if you have a different experience, please share that with folks, right? Because like a lot of this is going to be you hearing from each other and learning from each other. Okay. Again, feel free to chime in anytime. I'm going to continue on with a tactical 5-step process of how to actually run a campaign, raise a round, and close the round. And for a little bit of backdrop, this is something that I've used myself, but I've also seen many founders also use this process, and we've kind of honed it over time. And the example I'll give is about 2 years ago, there were a handful of student-founded startups that were in similar stages, and they had struggled to raise their very first round. And they were all, interestingly enough, trying to raise about the same. So I think it was anywhere between 200 and 300. And so I heard quite a bit of, I just can't get that first investor, or I've got a few investors and I don't have a lead, or I've got half the round closed, but I cannot get to the rest of it. And so it was pretty common for all of them. And so what they had done is they basically used this process, and within the period of a couple months, they went from the struggling to raise 250 to way over subscribing. And we're talking like 700, 900, in one case it was like 1.3. Right. And so there's definitely a tipping point when it comes to fundraising. And so hopefully some of these tactics will help you out. And that's what I'm going to walk through. So if any of you have a sales or marketing background, this should look pretty familiar. There's a couple different steps. I'm going to walk through each one of these. It's not rocket science. It's something that you can essentially take a checklist and you go down the list and you can do this yourself. So the first step is just making sure that you've done your basic prep work. And so there's nothing shocking about this. Is make sure you have an attorney, or you have at least someone that you trust. If you have co-founders, make sure you pull together a founders agreement, basic financials, like nothing super complicated. And then in terms of materials, just make sure you've got something that you can share, whether it's a little snippet that's a paragraph, or if it's a one-page teaser. People tend to think about the pitches these days in terms of like pitch decks. And that with the pandemic, it's been even more common now because we're not meeting people face to face as much. And so these are just basic things that you'd have. And so just make sure you do that before you even have a conversation, right? So just have this stuff, and you're going to iterate on this stuff. Step 2. So what you want to do is hone in on a target audience. And this is where, if you've done sales or marketing before, this should resonate with you. There is a strategy to make sure you talk to like the right set of people. An example I have from many years back is we had the founder, or actually he was the CTO of Pandora Radio, come in, and he was sharing in the early days what it took for them to get their first dollar of investment. And I think he said they talked to roughly 300 and 365 investors before they got their first yes. Now, imagine how exhausting that is. Like a no for every single day of the year if you were pitching every day of the year, and after a year you get your first yes, right? And was it because it was such a terrible idea? Was it because the founders weren't backable? No, it's because they didn't target their investors particularly well. And so save yourself a ton of headache by doing so. I'll rattle through these 6 different lenses for focusing. So the first one is around the stage of the size of investment, right? So if you're looking for your first 100K, you shouldn't be talking to late stage venture capital that writes $10 million checks, right? Kind of obvious, but I'm just going to throw it out there because I've seen this mistake multiple times. So make sure that the stage and the size of the check is roughly about right. So that should be a really easy one. The second one, and this goes to, I think, one of the questions that Sarah, you had raised, which is location. Previously, in the early stages, investors really wanted to be very close geographically to their founders. And so it became this thing where you generally had to be fairly close to the investor base. And so this is where I hear a lot of, oh, should I move to the Valley, or should I move to New York? Should I move to Boston? And especially for those of you that are in other parts of the world, there's this perception that you have to move in order to get to the investors. That's changed quite a bit in the last year because of the pandemic. But But what's actually been more relevant is that when you think about location, it's not so much investors as a location are located in the same place as you. It's whether you're located in the geography that makes the most sense for your startup. And so if you're doing a fashion startup, or if you're doing something that involves like movies, there's generally locations in the world where your customers, your partners, your supply, your natural resources are going to be there. And so that matters a lot more than where your investors located. And so it's a lot of these rules have kind of been changing in the last year. And so keep that in mind. So in the ideal world, you're all really close by, but keep in mind, like, location is a big factor. Industry vertical is another one. So this one's a fairly straightforward one, where if you're doing something in healthcare, you shouldn't really be talking to a consumer product investor, right? And so that's just kind of an obvious one, but not everyone does that. Investment thesis is another one where there are certain investors that have a view of the world where they're making a bet. Maybe the bet's on AI. Maybe the bet is on how the gig economy is changing how people interact, right? And so that thesis basically guides their investments. And so that's another thing. If you play into one of those, you should definitely keep that in mind. The business model one is fairly straightforward. Essentially, if you're B2B, there's certain investors that are much more B2C. So that's kind of a hard match. And so that's at the kind of most coarse level. But generally what happens is if you have an investor that understands how to sell to a customer type, even if you have a product that's foreign to them, if they understand how you sell, they could be a really good fit, right? And so if you're an enterprise software and they just enterprise software, but a different kind of software, like that really could be a fit. And then the last one is around this social filter. Whenever you can find someone that knows them, a lot of investors still to this day use that as a way to essentially cut out the noise, right? It's not exactly noise, but that's how it's perceived. And so if you can find someone that vouches for you, even better. And so ideally, hone in on the target criteria. You want to spend some time to build up that pipeline of potential targets. And on the left are essentially some places to find names. And on the right side, there's some tools. They're basically CRM tools to facilitate connections. So again, not rocket science, but you got to do some homework on this front. Okay. And the last piece around the second step that I'll just share with you is that there are some emerging lists of investors. This particular one happens to be a map that we pulled together that's primarily Boston based, but every region's got a different flavor of this. As you can tell from here, like the left side is typically kind of tech VCs. The middle stack is around like healthcare. There's corp VCs. And then depending on stage, like you can basically map out where investors are. And so if you go to that URL, you'll get the full list. It's an Airtable that you could sort on. Okay. All right. So that's step two. Again, chime in here if you've got any questions. Again, I want to make sure that this is actually sticking with you. This third step, maybe I'll just kind of pause for just a second here. This third step of socialization is probably either one of the most critical steps of success, and I'll kind of get into why that's the case. So some founders that pursue this, they've found extreme success using this tactic, and others just don't like using it at all, and they can be successful as well. But I want to walk through why this has been successful for a handful of folks. So on the socialization phase, there's a few things. Here's where you want to prioritize your sequence. I'm hearing a little bit of noise, and so if you're not talking, if you wouldn't mind going on mute, I would love the questions. So that would be fantastic, but background noise is a little tough for folks. So here's how it works. You've got your target list of investors. So let's just call it, you got 30 to 50 of them. You want to prioritize those investors. You want to sequence them. You want to find the strongest connections you can to those 30 to 50 investors. Sometimes it's warm, sometimes it's cold. It's fine, whatever you can do. But what you want to do over the course of if you have the luxury, it'd be ideal. If you don't, then you'll have to compress this period. Is over the course of 2 to 3 months, you want to reach out to that target set and you want to refine that target set. And when you do that, there's a few things to do. There's an old adage of when you want money, ask for advice. When you want advice, ask for money. And it sounds really trite, but there is some psychology to this. And this is why it really worked for some people. So there's kind of 3 key reasons why this works. One is when you ask an investor that you've never met before, if you ask them to invest right on the spot, the likelihood that they can do so with the limited amount of information that they have is just really low. And if you were to quantify that, let's just call it like 3%. So you'll talk to 100 investors, 3 of them will say yes, or maybe a maybe yes, right? Now, instead of asking for money, if you use some of these phrases of who would be helpful, who else should I talk to? I'm not ready to raise. What's a good recommendation for an expert in this space? And if you use those kinds of phrases and you don't ask for money, what happens is it improves your hit ratio, right? It improves your conversion rate to get something useful out of that conversation from 3% to 30%. Right. And so they'll put you in touch with the next person. And this will help you then build your list. So that's one key reason to do it. The second one is, even with that investor, you'll say you'll do something, 3 weeks later, something will happen. You go back and you get back to that person and you're starting to create data points, and they're starting to see a track record. And that's huge in order to make an investment, right? And so you're creating this trend for them to understand, and it demonstrates follow through, it demonstrates a track record. And then the last reason, and this also goes to the psychology, is that many of you, if you're at a stage where you're just testing the waters and you're not sure whether or not to make the raise, but you're essentially like, hey, I'm thinking about raising a couple $100,000, yada, 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 and you talk to an investor, the moment you do that, they think you're fundraising. And because it's generally a pretty small community, that word gets around. And so the worst thing you'd want to have happen is, let's say in 3 months from now, it's the fall and you're actually ready to raise. And during the summer, you were working on other stuff. The deal's going to look stale. And so when they talk to other people, you talk to a next investor, they're like, oh yeah, what's her face was running around talking about that 3 months ago. Oh, still didn't get funded. What's wrong with it? So you want to control your shot clock here. And by doing this socialization phase, you hold on and you start your own clock, right? You keep the timer. During this period, there's a few things. You're going to get a lot of feedback. You're going to get conflicting feedback. Incorporate some of that feedback. If you hear the same theme multiple times, then there's likely something that's not resonating with people. Maybe it's the content, maybe it's the messaging, maybe it's a fundamental flaw in the business, right? So if you hear something a couple times, then sure, do that, but avoid the back and forth. Can't tell you the number of times that I've seen the very last person that an entrepreneur talked to was the thing that they implemented. The next person they talked to, they implement it right back, right? So you don't want to do those, back and forth guardrail to guardrail changes. Okay. So that's the socialization piece. What's going to happen, and this is the fourth step, is that at some point, and you will know because you'll have a really clear sense in your spreadsheet of potential targets, who's likely to bite. So during this socialization period, let's just assume you do this over 2 months, you're going to have a really clear indication of, well, these 10 people sounded like they want to invest on the spot. Fight the urge, don't do it. You basically just say, hey, I'm not ready yet. Flattered, I'm psyched that the opportunity resonates with you. We're going to talk to you in the future, kind of thing. But you'll know, right? And they'll give you that feedback. And then a handful of people will be like, you just really clear that didn't stick with them. But in this case, you approach those top candidates at once. You now change the language from I'm not ready to raise to now I'm closing around, right? It's not I'm raising around. I'm very deliberate word choice. I'm closing around. The thing you want to do here is create some FOMO, and you want to create a time bound around it. And so by telling someone you're closing around, you're essentially getting that clock started for them. So it's changing the psychology. What happens here is you'll maybe get a soft commit, maybe a soft commit leads to a hard commit. When the hard commit leads to another person coming in, like that domino effect is what you're trying to generate. And the very first ones are the hardest ones to get. And the very last ones are the ones that are easiest, right? And so the whole goal here is, as a founder, you want to create that momentum and you want to land that lead investor and get that first domino knocked over. And then you can use that to basically trade off each other. And so in this case, the optics matter a lot. And so everyone wants to hear how they're in a deal that's oversubscribed. And in this case, the optics actually influences the outcome. So it's really important to manage this process yourself. Okay. I will go on and just kind of wrap up or keep going through like the last couple of steps. And this, I'll fly by this pretty quickly because there's a ton of content. And again, I've shared it. Two different structures, whether it's debt or equity, they have pros and cons to it. On the left, you see equity, and you see on the right, you see the debt side. Not going to walk into that. But the takeaway here is you're largely going to do like one of those instruments at one particular point in the round. Sometimes the investor has a very specific desire around doing one of those two instruments. And so sometimes the choice is less yours, but there are some trade-offs. The very final step here is that you want to make sure you actually close the deal. I know this sounds kind of trite, but there are a handful of considerations. You do a rolling close, in which case you lose the benefit of that time pressure. So if you do this rolling close, it's like, okay, well, I'll write a check this month or maybe next month, or I'll sit for a little while. And because the terms stay the same, the investor will push out the decision because it's in his or her best interest to do so. If you have a set close date, it's basically the train's leaving, right? And so you create that time pressure. And so depending on where you are, you may want to set a rolling close, or you want to do a specific one. And the money's not in the bank until the money's in the bank, right? So there's a difference between when you're that first investor versus your last investor. And in this case, that whole Glenn Ross movie where it's like always be closing, it's actually not always the case. For fundraising, yes, you always feel like you're fundraising, but you do want to set these windows because it influences the other side and how they view the deal. And so don't always be fundraising. You want to actually control that more. Okay. The next couple of these, again, I'm just going to kind of flip through this. It's a little bit of a quick math for folks. I often get the question, like, how much should I give up in the early days? And there's a ton of stuff on that slide, but I'll kind of give you just the takeaway here, which is in your very early days, you have a couple of different scenarios. You can raise some money on some valuation, and you might feel like you're negotiating horribly or you're negotiating super well. But the difference between raising $1 million round on a $5 billion valuation versus a $3 million, and you can see the math there. At the end of the day, if the subsequent rounds play out when there is data and there are comparables, that you end up owning essentially the really similar amounts of the company. And so in this scenario, you've worked at this thing for 6 years. In one case, you own 37% of the company. The other case, you own 33%. So it's not that much of a difference in the early days. So don't get hung up on valuation. You really want to find like the best investors. Okay. Talked a little bit about this. It takes a little while, and so you want to definitely plan for it. Speed's limited by how you reach just where people are. And then in general, you just want to make sure to pick your investors carefully. It's a little bit like getting married, right? And if you don't choose well, it's a little unusual because you can get unilaterally fired, and so that's not really a situation that you want to get into. And for a final thought here, although we've been talking about this primarily as selling to investors, keep in mind, especially professional investors, they need entrepreneurs just as much as you need them. It is their job to find entrepreneurs, and so they often get competitive with each other. And so keep that in mind, that it's not you selling to them the whole time. So it's more of a two-way street than you actually think, even though in the early days, it feels like it's a very one-way street. Okay. So I'm going to stop there just because there's like a crazy amount of slides after this. And again, all of it's posted, but I'm going to take this off presentation mode just so I can see everyone. And let's dig into some questions.
Yeah.
Now I can see the chat. Great.
David, I had a question about one of the slides is like the third step in the process of the network. And you said don't kind of take some of the radical changes into effect, but then after that part, if you don't take the radical changes that someone gives you, and you go back to them a couple months later to pitch them to invest, and you didn't take their idea, how do you go about that? Do you address like why you didn't take that advice they gave, or do you just kind of out of this?
Very, very much so. I think so great question, Matt. And I think this dovetails with something that maybe, sorry, you mentioned at the beginning, is that the feedback is often from the peanut gallery, right? It's from an investor that may or may not know the business, right? And some investors like to think they know everything, but most don't, including me. I have some experience, but I don't know this space. I don't know your business as well as you do. And so some of that feedback will be around things that aren't necessarily tangible or concrete. So what you want to do in general is you get that feedback. It's important to recognize that you hear that. It's like, okay, I understand that point. I see where you're coming from. And you make sure it registers, and it registers with the other person that you hear them, right? So it's not that you're dismissing it. So that's one of the worst things you could do, would basically just, dismiss all feedback. It's like, oh, you're wrong, right? So in this case, what you want to do is you want to like, okay, I hear what you're saying. You may or may not respond right away, right? It's more of a, I see your point. Let me look into that kind of thing, right? Just kind of going to table it for a little bit. You talk to the second person, third person that's unrelated. If you hear that same point 3 times in a row, then yeah, it's likely going to be something you want to address. And so it's likely something that you'll change. And so in that scenario, it's kind of easy, right? You got very consistent data. Let's talk about another scenario where you talk to someone else, like, hey, you should go to B2B. Another one's like, hey, you should go B2C. And then the next one's a B2B and B2C. You're going very conflicting back and forth. And so that's not super clear. I think in those cases, when you have enough of those conversations, there's either something in your model that's not working, something that you're not communicating really well, or the investor that you're talking to just doesn't either get your space, or they're just the wrong kind of investor, right? So if you're talking to someone that keeps pushing you towards, I'm using this as a broad example, the B2B case, because they know enterprise sales and they know how to sell it, even though either your founding team is ideally cut out to do B2C, or the real opportunities around B2C, then that's just not a good investor for you, right? And so you won't be going back to them and say, hey, we're doing the B2C thing because we heard what you said. It doesn't even make sense, because they're just not going to, it's not a good fit for them. It's not a good fit for you, right? So those are the things you want to keep in mind as you have those conversations.
Perfect. Thank you.
Cool. What else? I can look through the chat. I'm not sure if there's
David, one quick question. What would be your advice for student entrepreneurs on how to build credibility with investors?
Yeah, credibility is definitely a big thing. So one thing is time. You want to use time in your favor and to your advantage. And so as you talk to investors while you're a student, many of them are wondering whether or not, is this a real thing, right? That's the first thing, is like, how focused are you? When I was in business school, like I said, I was an accidental entrepreneur. If I was talking to an investor then, they would pretty clearly see that I was not really behind the idea, right? I was kind of playing with different things. And so if you're working on something, the first thing you want to convey is that the idea itself, the passion, the concept, whatever that is something that you're going to pursue. Whether or not you pursue it's a sort of separate matter, but in terms of just conveying that, let's just assume you want to pursue it. And so that's number one. Over time, while you're in school, you continue to want to go back and forth and make sure you have touch points with that investor. I'd say if it's someone in your space and someone that you really want to keep in up to date, every other month is probably a good frequency. Even if it's like here's a quick win. You just want to do this drip campaign where you're letting them know things that are happening, and you sort of keep top of mind. And so that's something that you want to do to build that credibility. Once you graduate, or if you're no longer in school, then that is a pretty big decision point. And so let's assume you're pursuing the venture. If you are, then that's a really clear signal that you are serious about it and all that. The other thing to build that credibility is that the more that you can gain traction and demonstrate that traction, the more proof points you're going to have. And the traction could be sales, the traction could be downloads, the traction could be just the sheer fact that you're recruiting more people, co-founders or other advisors to the team. So signs of like some evidence that this thing is a real thing, or other ways that you can create this perception and then the reality that you're on to something, and that's what you want to convince the investor.
Thank you, David.
Okay. Yep.
Like regarding traction that you just mentioned, like how much traction is enough traction? I mean, if I'm getting maybe 2 sales every month, but I've had like but it's growing and next month is 4 sales. How much traction is enough?
Yeah, yeah. The yes, and it's all the trend line, right? And so I'm a huge fan of whenever you can pick one indicator or one KPI that demonstrates an up and to the right, like even if it's for a short period of time, put that someplace in the deck, right? So it doesn't matter. It started from 2 and it went to 4. You basically doubled your sales in that period of time. It's like fantastic, right? And so that's one. Investors want to see that there's momentum behind it, and the KPI may not be sales. It could be downloads. It could be growth of a user base. It could be, if you're building an index of something like, number of sources, whatever that thing is, but something that goes up and to the right to demonstrate that this thing is working. Now, investors will have a sweet spot for stage. If you think back to that, one of the early slides that showed the 6 bullet target points, stage is really key. So some investors do have like a minimum stage in which they invest, right? So if you have, let's say you're a C, like an A series fund, and you basically invest, say, $10 million at a pop, but there's a minimum level of traction, and they generally have defined points like, oh, you need to be generating $1 million ARR, or if you're doing like an exchange or sales, there's a minimum GMV, gross merchandise value. And so those benchmarks are generally pretty well known the later stage that you get. At the very earliest stages, which I'm assuming some of these ventures are, that you're looking for folks that don't require all those proof points, because every single venture in the very early days had 0 traction at some point, right? And so there's a group of people in those early days that you're looking for. And so the ones that ideally would invest, or the ones that you're looking for, the ones that don't require those proof points. And there's the ones that are like, they believe in the vision, they believe in the founder, they believe that something needs to happen in this space. And you're looking for, I mean, there's some other adage, right? You're looking for not the skeptics, but you're looking for the believers. Your hunt for investors are looking for other believers, right? And so if you hear someone keep on giving you like oh, but this could happen wrong, or this, what about this? And have you thought about this? They're clearly a skeptic, and almost no amount of debate is going to, it's religious at that point, right? Like you could say one thing and they'll just say something else, right? But then if you have enough data points, then the person will be convinced. But then at that point, you don't need that person. So it does go back to largely trying to find the right people, as opposed to what's the minimum traction. And a good way to ask that is to ask that of the investor. What stage you typically invest at? What minimum proof points do you need? And some will be like, very proudly, we're first check in, or we lead rounds, we don't follow, right? So it's some of that Q&A. Right. I can also just look through the chat if, let's see, can I screen share? When's a good time to seek VC versus non-dilutive funding? The quick answer on that one is you generally want to try the non-dilutive first. VC is super expensive. It's what everyone typically talks about. It's glamorous, and actually, it's probably the wrong word for it, but there's a buzz around like institutional investment, but I'd push that off as long as you possibly can. Okay, Jonathan, so we've gotten conflicting information about which money to take first. Here we go. Some take angels, others say seed, other pre-seed. Okay, that's pretty on topic there. Do you want to expand, Jonathan, a little bit on that one, or?
Sure. Yeah. I mean, so I've been working on my project for a little bit and have done non-dilutive up until this point.
Yeah.
And I've been talking to people about larger check sizes. Some people, like you said, like brand themselves as like first check-in only. It's like, like if you've taken bigger money than us, then don't talk to us, sort of thing. Yeah. And they say, they'll say, go with venture as your first thing, because going angel will set you up. Like other venture firms don't want to invest in you if you have already taken angel. But then other people say, take angel because there's like, much lower risk and much friendlier people. So I'm just curious. I mean, you're angel, so it's probably a little bit biased, but.
Yeah. Well, I pride myself on being objective as possible. And so I almost always will try to put the entrepreneur hat on first. And so I think the way to navigate that is that depends on who's answering the question, right? Exactly. And your intuition for this, I think, is pretty spot on. Depends on what their incentives are. And so if they're a professional investor and they're VC, they clearly would, give you advice for, and some are great, and some will say, well, if I was in your shoes, I would do something differently. But they're obviously have a certain incentive around that. I think in your case, and maybe this applies to many of you, that angel funding does not preclude VC investment. It used to be maybe 10 years ago that there were much more, there was a much harder line between the two, right? Those stages that we talked about, the friends and family, the angel, the VC, used to be like almost stage gate. Like there was an angel round and only angels were in it. And then after that, you had enough traction. Then now you have to do an institutional round. About 10 years ago, I started seeing many more angels and VCs invest in the same round, same terms. And then that's even gotten to the point where, especially in Boston, that it seems like it's gone the other way, where in any given round, it feels like a really well subscribed round has both, right? The professional investors that understand term sheets and are super connected, but they also have like a set of operator angels that they're very much like, well, get smart people that know the space, that understand how to do business. And we actually want to carve out room for angels. And many of the local firms, including G20 and sorry, local to Boston. I know you're not in Boston. G20 underscore, they have these like groups of other angels of which they actually have some participation in it. And so it's almost like they've now, I wouldn't say require, but they like really see the value of these operators that change the trajectory. And so if you have angels on your cap table that are notable people that are in the industry that are well respected, then I honestly don't see a venture firm looking at that, be like, oh, you know what? You've got a really smart person on your cap table that knows the space. I think that's bad. There might be an economic reason, right? It's like, well, you know, so much of the cap table is already chewed up. We need to have at least 20%. In which case, then that's a challenge, and that's legit, right? That's their business, and so I could see maybe that, but it has less to do with angels. It has to do more with like the percentage of ownership. And so I think in your case, you could structure it in such a way where people are adding value along the way, and so you don't have to make that kind of decision point. Okay, just going down a little bit further. Can you paint too? Oh, I love this question, Christina. So can you paint too big of a picture? Yes, there's one slide. It's actually one of my favorite slides that I didn't get to because it was the tail end. You cannot actually paint too big of a picture. And so I know this, you have to take this with a little bit of grain of salt. Whenever you talk to an investor, think of this as needing to tell the other side what your ultimate goal is. And so I'll bring the mountain analogy, which was the image that I had, right? And so you're climbing a mountain. It's really important for you to communicate the tip of the mountain, right? So we're going to reach the top of Everest, and you paint whatever that is. That's assuming everything goes right. This is maybe slide 2 of your deck, where big problem, imagine a world that problem doesn't exist anymore. And you paint that, right? And so it's as big as possible. And when it comes to institutions, because they're looking for the home run, that's the best case scenario that you want to paint. And so that's one anchor point. The other thing you really want to communicate is like what your base camp is. So your next credible step, where sure, that big picture vision sounds really cool and pie in the sky, but I also want to know, how likely is it for you to get to that next stage? So the next stage may be 6 months. The next stage might be like, get a couple prototypes. You maybe have you land your first customer, but that base camp is really important for you to communicate. And the short of this is, when you talk to an investor, make sure that they understand what your big vision is and your credible next step is, and try to communicate in a very short period of time. The danger if you don't do that is that if you just tell me what your big summit is and I don't know your base camp, I walk away thinking, well, who is that person? They're like, they're not connected to reality. And then the reverse is also just as bad. If you only get to tell me about your base camp, I will walk away thinking, oh, kind of cool, but pretty small, not a big idea, but good luck. It sounds pretty good, right? And so you want to communicate those two things in a really short period of time. And however you best pitch it is kind of, you're more of your style. Some people love doing that. Oh my God, this is massive. And here's how we're climbing the mountain. Others, kind of bring people along the journey, which is, we're here, we're going to do this, and that's going to build that, and that's going to build ultimately there. But you want to figure out how to share that with someone really quickly. I know we're getting just to the end. And so I think the other, I'll just rapid fire the last two questions on and here. Determine your valuation. That's largely, an art. So it's basically whatever someone will pay for. And so because it's generally negotiated. And then on the inspiration, I have started a handful of things, and it's large, in my case, it was born out of previous experiences. So we did a mobile photo sharing thing because my previous startup, saw that problem. I think many of you are in spaces where you see a problem either because you lived it as a customer, or it's just a problem that you see day in, day out, and you get passionate around it. It can come from anywhere, right? And so I think shortage of ideas is not the challenge here. So that's it. So I just wanted to at least hit the 6:30 mark. I'm happy to stay on later if folks have questions, but I wanted to at least respect your time and nail the 6:30.
Wait, before anybody leaves, I am putting in the chat a link for a survey. So please fill it out. Let us know what you thought about this workshop. We would really appreciate it.
Thank you so much for all these great advice, David. Really appreciate it on behalf of all the Innovation Center team at Brandeis University. We thank you for sharing all this great advice with the entrepreneurs.
Happy to do so. Hopefully it was helpful, and thanks for everyone for spending some time together.
And John Kelly, thanks for pointing out that permission is needed for what you're saying, the Google survey. All right, so Sarah, just make sure you open up the permissions. And yeah, this was great. Thank you so much. All right, we all good?
All right.
All
Appreciate
right.
it. Thanks
David.
everyone.
All right, bye-bye.
Have a great night.
You too.
Bye-bye.